Kai as the entrepreneur inside. We started in the Silicon Valley and we now have 60 chapters across the globe with 10,000 people. And we have events like this every month. This is the first event of 2015. And thank you once again for coming. Today's event, which is going to be moderated by Christian right here, and I'll hand the mic over to you, over to him in a second, is all about starting a business. And one of the biggest things about starting a business is about funding. So all the way from angel seed to Series A. We usually like to have the session interactive. The panel over here have a phenomenal amount of experience. And we hope that through the discussion we'll get something out. And at the end of the panel, we actually like to throw the mic open so you can interact with the panel. So without much ado, thank you very much once again, and I'll hand the mic over to Christian. Christian, thank you.
All right, thanks a lot, Pooja. Hello, welcome everybody. So yeah, my name is Christian Geissendoerfer. Maybe very quick introduction of myself, but then over to the panel. I'm German since 2008, on and off in Singapore, since 5 years living here. Building and running my own company, it's called Yoose. We're a location-based mobile ad solutions provider across Asia and Europe. I've personally, over the last 7 years, raised about 800,000 Sing$ for my own business. Running right now at like zero, I would say, and trying to grow it further here out of Singapore. So I've been in touch with the startup community over the whole time here and in Berlin, in Germany, and in Europe, as well as in touch with investors. So William, for example, was one of the first ones I met back when I first got into Singapore. So I'm looking forward to bring through the questions out information to all of you which is relevant. Before I introduce the panel and or ask each of them to briefly introduce themselves, just a quick question. Check with everybody in the room. Who has raised money for a startup business here in the room? Just a quick show of hands. Okay, a few. The panelists? No, you didn't raise any money? Okay, 2 of them. 2 now. So, well, we'll judge on the expertise later on then. All right. So, just to get a little idea also for the panel, what type of questions, answers we're bringing. But without further ado, let's introduce the panel. We have 4 people from very different backgrounds. From tech entrepreneur over family office, over tech entrepreneur again, but with a different twist, and fintech. So okay, it's a lot of tech around. But then I hand it over straight away. Just introduce yourself briefly and share one fun fact about yourself as well.
Hi, I'm Raj. I run a business called Smart Karma. We're a relatively new company. We only incorporated in September last year. We've just raised around the funding. We raised 1.5 million US for this. Prior to this, I ran another financial services company. We raised only 1 round for that business, which was a $6 million US round. A fun fact about me is that I'm learning how to bake bread these days.
I'm Rodrigo. I'm from Chile, but I lived most of my life in Brazil. I came to the panel to try to bring a little bit of a contrarian angle to the panel. Basically because the companies that I've built and sold in the past had no outside investors. So I hope to mess around a little bit with people's minds with respect to financing.
Hi, I'm Pooja Gurbani. I run my family office. I've also helped start another family office in Singapore called Crossbridge Capital. It's a multi-family office. And today, I'm also involved with a company that's creating software for family offices. So we can actually do a lot that without using our private bankers.
Hi, so my name is Klippgen. I'm from Norway. I've been in Singapore since 2003. Done around 20 early stage angel/seed investments out of Singapore, most of them in Singapore. Right now I'm working to launch a new venture capital fund, also out there. So speak with later if you're interested in joining that. A fun fact, you said?
I did, but I'm not.
Okay. I just put my vegetable garden online, so now my vegetables actually speak. Wi-Fi to my smartphone.
You want me to say about that? Well, I attend a lot of banking conferences and I receive a lot of junk I don't like. So actually I started a small company where I actually create products that I want to receive and I sell them to the banks.
It has to be fun, right? Okay, well, let me see something fun. I think the beauty of building and selling a tech company is that eventually you have the option of something that I've been advocating for, which is to live like an Italian, eat, drink, and love.
Sounds good. Can you hear me through this one? Okay, all right. No. Let's get started here, jump right into it. I think one of the first questions is actually, do you need funding and when do you need funding? I think that will make a good start, and I guess already from what I hear from Rodrigo at least, we have maybe two different base opinions, but I would ask probably William as first to go for it. I give you the microphone as well.
No, I have a lot of respect for founders that don't raise funding or don't want to raise funding. I think actually this will sound like it was fine.
No.
Anyway, but I think it really differs by which kind of company you're starting, right? So what kind of company are you starting and when are you starting it? Most of my companies are in the online space, right? In the online space in Southeast Asia is kind of repeating a story that already happened twice before, right? So you can actually travel back in time. You can know exactly what's going to happen in 2017, 19, 21. So it sounds like it's boring. Actually, it's pretty fantastic in that sense that you know what's going to happen. If you are in the early phase of this, right, the last 5 years, we actually started a lot of online companies without having to invest so much in marketing because you're probably be the only one doing it. So that's important. That's factor number one. The second factor is if you do some kinds of businesses that require a lot of working capital, you actually need that. If you start to sell luxury bags, you need like $1 million in inventory to be able to do that. So again, it depends, I guess, right? But there are also smart investors, smart entrepreneurs that can go back the company by making sure that they don't have to pay the bills before they actually get paid themselves. So big respect for people that delay funding or don't need funding at all. For some businesses, today you just need to get funding fast because that is one of the reasons you actually can build sustainable competitive advantages and a barrier to entry in the future. So it really depends. I can pass on the microphone.
Rodrigo.
Okay, so well, anyway, just to clarify, I think William gave a very good answer. The answer is it depends, right? It boils down to what kind of business model you're starting off to begin with, right? I'm very keen on subscription-based business models, which actually allow you to delay funding as much as possible. So I think, thank you, hello? Yeah. So at the end of the day, it's a lot about the decisions the founder, the entrepreneur makes very early on as to what kind of a business he wants to build. And yes, there are certain types of businesses that are highly competitive that you're going to really need to invest in marketing. And for most founders, they really have to reach out to capital. But because I'm in the business of building and selling a company and trying to bootstrap that as much as possible, because at the end of the day, the fact that you bootstrap will mean that your return as a founder later down the road when you exit will be much higher. I tend to choose business models that require less funding, like subscription-based models.
I've got a strange way of looking at this. I feel the answer is very similar to when are you ready to get married. It's very simple. Because that's what fundraising is all about. You're bringing in an external party into your business. He or she will start dictating, asking, inquiring, influencing the way you're building a business. So be prepared for change, right? Just like marriage, right? So be prepared for change. And when you think you're ready for that sort of change, when you think you've got that level of maturity as a business, when you have a sound business plan, when you know how you want to grow, I think you're ready to raise money for that growth. And I think at that stage, you will be able to articulate a clear vision for your company to your future investors. you will be able to explain how that capital will lead to a multiplier effect in terms of revenues and or profits, but definitely extra customers, you know, whether it's subscription or anything else. And then you would even know how much, or if anything at all, you need to raise. But my own personal belief right now, given the market that we're in, is that we're living in a zero interest rate environment, which means that if you don't raise money to grow your business fast enough, someone else will, and they'll grow it faster than you. And the threat of competition is more live and real and bigger than you would imagine. Hence, if you can, if you have the vision and the maturity, you're ready to get married, get married.
Sounds like a plan. So let's assume you have you are at that stage and you're ready, and I get back to you. Was it no Pooja? But no, at the later stage, because I guess what I want to lead it to is now. So once you raise money, there are different stages and levels of raising money. So there's so-called angel investment, which is kind of the first $20, $50, $100,000 of capital to get started, to validate an idea, basically to start building a small first team. There's government funding for that as well, grants, especially here a lot in Singapore for that. Then you get to something which is a seed funding, which will probably go up to $500,000 in size, maybe sometimes up to $1 million, where you can combine government grants with first very early stage institutional investors or so-called super angels, so investors or former entrepreneurs who invest in multiple businesses. One of those is over there, right? And then you get to Series A, Series B, Series C, and so on funding. So the larger rounds of funding, which is a pure growth funding then. So you're generating revenues, you need to grow a team, you need to grow a sales force and all that. So these different stages, of course, most of them come in sequence, yeah? But there's different then approaches how to make this first step. Because if you have never, and the majority and never has raised money. So my question to you, and sorry, also for the family office, that's Pooja's point. So, question to the panel: how to approach you as an investor, or those who are not an investor yourself? In your example, how did you approach your first investor? And start over with William probably first.
Yeah. So a lot of people often ask me that question. I think what I find is that I think it's important to understand the background of the investor you're approaching. And I think that there are probably only a handful of investors that are actually perfect for you, depending on your business idea. So I think the best investor to approach would be someone that has done something in your space before. Not only because they can add more value, he or she can add more value, but they can also basically probably not need that much convincing, because he or she has already thought about that business idea for this business space and understands the metrics and all that. So I think that's really, really important. I get a lot of cold calls, and I don't know. First of all, you shouldn't really call an investor, I think, or disturb or be very intrusive. But I think do your homework and understand the background of the investor before.
Well, when I got approached by people looking for investment, the first thing I look for is the person's commitment. Actually, because a person can write a very good business plan. I want to know that they thought through their business plan. But most importantly, I want to know their commitment to the business. I mean, I've once had someone who showed me a business plan, but the person was living in LA, trying to run a mobile app company in India, and had a friend in Singapore who was going to help him. But he had no intention to move to India, and to me, I didn't see the commitment in that investment, in the entrepreneur. So for when people approach me, that is one of the main things I look for. And also, as I said, the business plan has to be well thought out, and I want to know the person's experience in the sector that they're trying to get involved in. If someone's an artist and is trying to start, just a fintech company, it's something I would be less interested in.
So I always consider the entrepreneur's side, right? How can he benefit most? And obviously I would advocate for holding back, trying to get an investment for as much as you can. But at the end of the day, it's a negotiation, like many negotiations out there, right? When you're going to seek an investment. So any negotiation, you want to have leverage. You want to have leverage because In Brazil, there's a saying. It says, "Quem tem o dinheiro tem 2/3 da razão." Basically, that means the one with the capital is 2/3 right. So when you're going to approach an investor, he's the one with the capital, right? You might as well have some kind of a leverage, significant traction. I love the idea of commitment. So if you say, look, I burned my bridges, I burned my ships, I moved my team, there's no going back to South America, wherever you came from, and I'm in it for the long run, I have no other option than to succeed. That would be a very interesting investing candidate from an investor's perspective. So, like I said, delay it. If you're going to go down that path, try to go with as much leverage as you can, so you don't get a bad deal, right, at the end of the day.
Well, Raghav, how have you approached your first investors?
I've had two experiences, and both times it was a very, very different approach on my team side. In our first fundraise, where we just did one bullet big raise, it was $6 million US, as I was saying, it was very different. We knew we needed a particular type of investor, a big financial investor, and we basically did a lot of research, like what I was saying, and in fact, we were able to narrow it down to one single person in Asia who would exactly fit the needs. And in doing that research, we also knew that we have a lot to offer to this particular person. And we went to them. It took 3 meetings, and we converted. So it was the first step, and it was to an investor, basically. So, but in my latest business, which is Smart Karma, actually, funnily, I was sitting with Pooja a few months ago discussing my fundraise round. And this is the second time I'm seeing it. That time I was actually raising funds. But the approach there was very different, because this time I'm building a business where I'm using my previous experience, but I'm also trying to tap into multidisciplinary expertise, which we don't have. So the first thing I did was, me and my team did, was to build a very, very deep and wide team of advisors. These were people that we spoke to over and over and over again to try and validate and get inputs into my business idea. So going back to my previous answer, to get maturity into what we're about to do. And as it so happened, a lot of the advisors themselves then came back to us and said, we want skin in the game, we want to invest. So it became a very natural outcome of an approach we took. And I sort of believe in that. I think that if you spend enough time thinking about the business you want to build and discussing it with people that you want to serve or bring together with that business, you'll end up connecting with the right advisors. And I think that natural connection brings leverage. Because then it's no longer cold calling. It's no longer artificial. It's a natural progression of the way the business is going to grow. And so that's how we ended up doing it.
Okay. Thanks for sharing that. I think I want to turn it back over to Pooja for a moment, because family offices is a little special investment environment, let's call it that way, a bit more discreet probably as well in general. And so I would ask you both to share a bit to explain what a family office is, and if family offices invest in startups, and if yes, how so?
Okay, so the family office model in Asia is much newer than it is in Europe and America. Basically, there are two types of family offices: single family offices and multi-family offices. Single family offices is one family that's big enough to run their own and have their own investment team looking at all asset classes: bonds, equities, private equity, real estate, venture capital. And then there's multi-family offices where it's normally a group of bankers who've left and brought on their clients, and they're running multiple families so they can share the resources of those bankers. And now in Europe, VC investments has been happening for many years. I mean, the guys from Rocket Internet can tell you. Actually, the company that I'm on the board of, a multi-family office, Crossbridge Capital, we have a London office. And we helped raise some money for Rocket in London. And we had a lot more traction than we did showing it to our Asian investors, in all honesty. And we find that Asian investors, they like specific deals more than the fund. We had this conversation, the ones I know, because they just like, they think they are smarter to pick those deals, and they get the thrill out of picking the most exciting deal, and I think that's something they enjoy. The type of people that actually do the VC deals, because we do all access classes, are the people who have more interest are the ones who actually have already been involved in the tech space. You see, I mean, we find a lot of the time, if you made a guy who made money in real estate, he just keeps wanting to roll into real estate. Unless sometimes the next generation comes along, but they got involved in tech in school and they want to get involved. But traditionally, if the profile is of the investors from the family offices who actually do the deals are people who made money in the sector, or the next generation if they are taking care of the funds, and then they are a little bit more savvy to understand tech deals.
So if I'm a startup, can I come to you and get money?
Okay.
I'm a startup, I'm raising money,
Yeah.
can I come to you and try to raise money from you directly?
Well, me directly, I would have to do it personally. My father would not touch it, in all honesty. So my clients touch it. Part of our Crossbridge Capital, my dad made money in real estate and commodity trading, and as you know, VC is an illiquid investment. So if he wants, his idea of liquidity is real estate. That's it. It's liquid or it's in real estate. You know, so my dad's not the profile, but me personally, I've actually wanted to invest in BitTorrent many years ago myself personally. Yeah, actually the founder is a good friend of mine, so I do look personally at some deals, but it's not as big as what my dad can do.
Right, that's really more on the personal. The question was more tailored towards an average family office. Would they directly invest in startups, or would they rather invest into a VC?
I think in Asia, it's more direct investments into startups or a little more growth stage. In Europe, they're more interested in VCs, but in Asia, they have the thrill. If they want to do it, they want the thrill of choosing the company. That's what we find.
Okay. So far, any questions from the audience actually to that? How to find the investor, or rather, how to approach them?
How to find an investor? Where do I find these people? Is that directory?
It's a good question. I mean, I spoke about the different stages. You have business angels, you have early stage, you come, and so maybe you can elaborate a bit.
That's a very good question, and the funny thing is that the guy that's advocating for not getting investors or delaying is the one that's going to give you the answer, right? So there's, I think it's someone in the corner there, Meng Wang, the founder, currently chairman of JFI Asia. One of the contributions he has done for the ecosystem is he created something called Meng's Map of the Money, which you can actually Google it, or you can, I think it's somewhere in the corner there. It's kind of like a directory of most of the VCs and also some government entities. Yeah, he's always updating it, which is good, so you can take a look at it afterwards or Google.
But those are more institution investors. How about angels?
Okay, I can't answer that question. No.
That angel and
So there's something called the Business Angel Network, BANSI. So if you go to bansi.org, or I think it is, just Google BANSI, BANSTA. They have like monthly or bi-monthly meetings, and they have a lot of members. The member directory might also actually be on the website, and you can basically find most of the business angels in Singapore.
So
That's where let's start.
no, I mean, be devil's advocate. Do fancy angels really invest?
Yeah, well, they started to invest more recently, but yeah.
Or should I rather go to Angel's Gate or any of the other reality TV shows?
I don't know. I think Bansi is still the best place to go, or actually hang out at places like this. I mean, Jay, I don't know how many of you actually know what happens at Jay's Product, but it's a fantastic place to actually meet not only very good startups, but also very good business angels. This is a really meeting point for looking into the tech ecosystem in Singapore, right here in this room. So there's like open Fridays, every Friday at 6. You can come and hang out and meet people. If you don't find the right angel, you can probably meet other entrepreneurs that can point you towards angels.
So why don't you just go to AngelList or Kickstarter or any of the sort of online funding platforms? I mean, I personally invest as well. We run a much smaller family office, my parents do. And for a while before I started doing my own businesses, I was sort of helping with that. We are increasingly finding very, very good startups on digital platforms. And it's actually helping investors who live in one part of the world invest in companies in another part of the world, right? So in January, not January, in August last year, we invested in a Japanese business, which we discovered on AngelList. Maybe you can give that a shot. We've had a very good experience.
And the networking part, I think, well, maybe Rodrigo can share a little bit about JFDI's investment approach and about incubation. Because you're invested into JFDI, right?
Okay, thank you.
So basically, JFDI is Southeast Asia's most prominent startup accelerator, and they have a very specific approach, which is to take their accelerate to what they call investor readiness. So that's what they're aiming at. They will either accelerate you to crash landing, starting something different or forgetting about startups, or to the point where you can actually present at their demo day event, and which will be filled with investors and all sorts, right? And basically, you can do an online application. I think they just finished their current application round for the next batch. They work in batches, right? So you need to send them an application, and if you get selected, you will eventually move to this other side of the room, where you will be there for 100 days, and they'll work with you to help perfect your business model. So it's one of the ways of building a startup. It's not the only way. There's a lot of other ways as well that you can explore. If I may just touch on something that he mentioned that was very, very important, right, about advisors, right? I think I'm beginning to see that more and more advisors are starting to be valued as they should, right? And versus a couple of years ago. So I think there is no one better to advise you in terms of your business model than those that have actually built similar businesses in the past and have successfully either taken them public or exited or are very sustainable. So I think you really need to choose your advisors wisely, and they can be very beneficial for fundraising or actually in your overall strategy. So I just wanted to emphasize that, which you brought up. So very good point.
One point, in terms of angel investing, what I have found is that if you're looking for a specific industry that your company is in, sometimes you find angels within the industry because they believe in what you're doing for their industry. For example, I'm involved with this company, Receipts, which provides software for my industry. Hence, I've got involved into the company because it caters to me. So I see the value in it. So that's sometimes a good place to find your angels.
Thanks. So far, any other questions at the moment? Yeah.
A question. So there were three themes. So there were three themes. One around bootstrapping, commitment, and maturity. And you also brought the different stages of investing. As a startup, so having bootstrapped the company so far, is there a certain benchmark that investors will look at in terms of how much money you have put in yourself and bootstrap how far in terms of traction before you can approach them to make any investments? And the second question is, does it have to be sequential, given that competition is also raising money? Does it have to be sequential, as in angel first and then seed, etc., or you could just go from, you could just start raising at seed at 500K or?
Back then there are different, I think, examples. One I can give from my own industry. There's a startup here in Singapore called PocketMart. They bootstrapped. They had from the founders' own funding, and the first money they ever raised was $10 million. So you can make that first jump. Well, that's not the regular way, but it's definitely possible. So yeah, you have two questions to the panel.
I can answer the first question. Yes, it's the value proposition is a lot better if I see you also have money in it. The worst. To me, it's definitely a no-no when first of all I don't see the skin in the game either. By sometimes you have people say, okay, I'm not going to take a salary out of it in the beginning because I want to own the equity and I don't want to give up more equity. To me, that's commitment. and also if they themselves want to put money into the company, that to me is commitment in addition to, you know, all the things they're compromising to get this business done. Actually, as I said, a business plan, eventually, a lot of the times it changes. I mean, you heard of Snapdeal in India, right? Snapdeal originally started off as the Groupon of India. But these guys were still committed when they saw, you know, they were not getting the traction they wanted, they changed the business plan. But what was key is the entrepreneurs were committed, and the entrepreneurs are mainly what you're backing, because businesses change all the time.
Maybe William enhancing the question towards you, because the word brought up by you was traction, right? So, and I guess
traction is needed. Yeah.
Yeah. So you've seen a lot of business coming to you for fundraising. So how do you define traction? What's traction, and which traction motivates you?
Just to start off with, kind of how much you have to get an investor. It depends on what type of investor you are, right? So that's why you have different investors. So I can just answer. Let me answer like a business angel, for example. I don't care about how much money you put in. Actually, I put more emphasis on actually what you have done, what your plan is, what the current product is, how your team is put together, and also the chemistry, right? How much does it seem like you can actually learn from me, and how much can I learn from you, and how can we actually work together? The traction that's needed, I think for business angel, you don't always have to show that much traction. The fun thing is, well, a lot of business angels actually, this is actually funny, a lot of business angels do not invest for financial returns. Some business angels just invest because they have a boring life, or they want to meet young, smart people, or they think that, you know, in online space, you know, it's fun with this internet kind of thing because they read much about it. So you find a group of business angels also in Singapore that actually do not care that much about traction or business returns. It's more that thrill, excitement, you know, being able to tell people you're investing in business. Then this goes all the way to people who actually live off investing as business angels, more like myself. I don't get so much thrill out of investing in it. I do to actually have fun as well, but also actually in the end make some money because I live from being an investor. So that's also important to kind of understand before you push. But yeah, so traction is not always necessary. If you go to a larger investor like a VC, though, like I'm trying to start right now, you certainly very often have to show some traction. It can be a very clear milestone that the investor has internally and agreed with their co-investors or investors that would be, you need to see revenue, for example. There are investors that say we need to see quarterly revenues of at least $3 million, for example. Those would be more like Series B investors, or so each investor has his own deal with us. You just need to figure it out.
So I'm going to try to present an extreme example of what would be the ideal investee in my, according to my criteria, my personal understanding, right? So number one, the team is out of the comfort zone. Okay, so that commitment is out of the comfort zone. They have to be somehow with something at risk. It helps a lot when you have to be successful because there is no plan B or plan C, right? So out of the comfort zone. Different from what you typically see in these financial brochures about mutual funds or stuff like that, where they say they have all these nice graphs saying that the stock market, whatever, is going to be great. They always say that has that small writing that says past performance is not a disclosure. Right? Past performance is not an indicator of future performance of the fund or whatever. But when it comes to successful entrepreneurs that have actually built things in the past, it's actually quite the contrary. I think because they've done it before, they know the process, they know the journey, they know the traps, the pitfalls. So I would love to invest in a serial entrepreneur that has built companies in the past, that is out of his comfort zone, and this is going to be a little bit controversial, but I'll try to back it up with data, and is actually in the business to make money for himself. And that sounds kind of like, why make money for himself, right? Well, basically there's I think it's GEM Institute, the Global Entrepreneurship Monitor or something like that, and Endeavor, these two large institutes that look at entrepreneurship globally. And they've been studying the whole entrepreneurship thing for many, many years. And they came out with a report a couple of years ago about high growth companies and the middle growth companies and low growth companies. And this is online, by the way. They realized that the companies that had the highest growth, the companies that created the most amount of jobs, which at the end of the day is the best way you can impact poverty, which is creating an honest paying job, were entrepreneurs that started the businesses to increase their own personal wealth, as whatever that can sound like to certain people out there. So those would be the three things I would look at. Done it before, out of comfort zone, wants to make money.
I don't know what I can add to all of that. I think it's pretty comprehensive, but I'll go back to my marriage analogy. You know, how many years do you need to date before you know you're ready to get married? I think that's the answer, right? It's the same way. And you know when you know. It should be the same way with the business. I don't know, I feel that too many of us are just too enamored by the numbers we read and all these publications and so many millions, billions, whatever. Ultimately it comes down to very, very, very small things, operational things. And I think once you've spent enough time making bread from dough, you'll know you want to get married, and that's when you go and raise money, and then you'll know how much you want to raise. So let the business dictate its needs. Spend more time thinking about the business, and it will tell you its needs. And once you know that, then you know your answer. Just don't do it because you're reading about it in news, that so-and-so has raised this much, and hence I should be going to raise that much as well. Find your own approach to your own business, be unique. I think the really successful business people, they like to do it their way. I mean, Pooja, you mentioned Rocket, right? I mean, they have their own unique strategy. I think it's bloody brilliant, no matter what people think about it. And their business thrives on just burning through capital very quickly, but that's their business model, right? Their business tells them, in order for you to do what you do, you've got to burn a lot of capital. So they do that. There are other businesses like the ones that Rodrigo probably did, which are don't burn much capital, bring in as much revenue. I mean, you know the answer to that. So the business does that.
Maybe adding one point here also, which was partially mentioned, but networking, right? Networking with other entrepreneurs and entrepreneur support organizations. I mean, entrepreneurs organization, I think was mentioned, EO, which is an organization for people who build a company with has at least $1 million in revenue, so that's a quite hurdle. Not many are there, but there are other ways like entrepreneurs drinks and all kinds of networking where you can start build your own network of entrepreneurs and people you can discuss with whom to approach, how to approach. So I think that's very helpful as well to get around further. I'll pick up on your analogy of the wedding, the marriage.
Yeah, I'm actually wondering why I keep talking about marriage today. It's strange. I am, yeah, my wife's been traveling.
No, you've been there. I've been there, I've done it, I'm not married anymore. Just sharing. You have to give funds, so that was the good part. I did have a marriage contract, which in my case was not a problem, but the bridge I want to build here is once you get to an investment, once you want to get married with an investor, and it's literally like this, right? Usually you invest in those who better than your wife or your husband, at least the financial part. The part of it I want to get to is like, okay, what's kind of the legal framework around? Let's assume an early stage angel investment or early seed investment. What forms are there and what legal framework would the panelists advise or give tips on?
Yeah, this depends very much if you're coming from an entrepreneurial or investor side of things. I mean, what you typically see actually is that when you do an angel deal, the business angel is usually not necessarily that savvy in requiring all these special treatments that the VC would require. So you typically see like common shares, and you don't see really preference shares. They're usually very simple agreements. Now, if you come to a VC investment or a more professional syndicate of angels or a seed investor, you typically have preference shares. or you have an investment agreement that is more of a convertible. So there are like two major forms that we really think about. Is either that the investor buys equity in your company, or that they buy basically a convertible that will convert to equity based on some future event. Right? And this is very normal in Silicon Valley. It's normal there because it's more of an entrepreneur's market. In Singapore, it has been more of an investor's market so far. Now, with all these new investors coming to Singapore, perhaps actually this will turn more into the entrepreneur's favor, which is, of course, I fear because I'm an investor, I don't like that. But you're probably going to see a lot more entrepreneurs offering convertible notes instead of actually equity, which is not good for the investor, but it's fantastic for the entrepreneur because you control what kind of dilution by that. So typically, and then convertible note says that you will finally give the investor equity at a discount to his next round. What really happens sometimes, though, is that if it takes time to get to the next round, the value of the company perhaps goes up 10 times in reality before you get the next round, but the investor only gets a 20% discount to the share price in the new round, which is great for the entrepreneur and also good for the investor. So those are two major forms. And then when it comes to special treatment, that usually happens more in the later stages where you have special rights on the board, for example. You guarantee the board seat, you guarantee certain rights, you can veto certain things. JFDI actually has a nice template you can get free, probably, and you can get a lot of this online if you want, but just come to me and ask if you have any specific questions.
Yeah. So, do you have to go to a lawyer, spend a few $1,000s to get a convertible note contract? Does the insurance have one?
You're starting to see a lot more contracts now being offered online. There's actually a company called Law Canvas. I think it's starting here in Singapore. The business model is actually to offer these contracts for a small fee instead of having to go to a lawyer. I mean, it's always smart to go to a lawyer, but it's always smart to have a contract ready before you go to it, I guess.
Family offices invest in other lawyers, so I think it's...
I don't have much experience with that.
So maybe we can share on it. So there's actually a kind of open source initiative on those. There's a convertible note contract. There's a standard term sheet for equity investment, a standard consulting agreement available. It's a few Singapore entrepreneurs put that together, put it online. So there is stuff available around it. So my point is, you don't have to spend thousands of dollars from a lawyer of your $50,000 investment to get that first thing done. But still, what's your experience on the contractual side of the two investments you got in?
I mean, both times in my experience, I've been trying to build enterprise businesses, and I think in enterprise businesses, you really do need lawyers for not the most obvious reasons. I think it goes back to the previous question that we were answering, where there was talk about commitment and so on. I actually think there's, and you talked about serial entrepreneurs as well, right? So whenever I think of investing, and it's got nothing to do with startups, any type of investing, I think about credibility, right? I think the biggest thing a good human being can lose in life is his credibility, right? So for me, credibility is the biggest type of commitment, because I mean, if there's like a super rich, I mean, if Mark Zuckerberg starts the next business, I mean, how much money does he have to commit before it's commitment, right? So sometimes commitment comes from credibility and not money. And I look for that in investing. You know, how credible is this guy? Can I back this guy? Because he's putting his credibility, his reputation on the line. And I think that's where it ties in with the legality as well. Sometimes the type of customers you're going after or the business you're building requires you to have a certain image. It could be very, a blue chip business which is watertight against regulation, or threat of regulation, or, So I think increasingly we do need to think about that. Whether it's a tech business, and you might be wanting to think about your IP from a very early stage. If you're building a financial services business like I am, I need to think a lot about regulation from a very early stage. And for that reason, I've always spent up on lawyers. And I think good investors, whether they say it or not, I think will get some sort of comfort from knowing that you've had sound legal advice around your business model and it's robust around, that type of risk. That's what I'll say. I do appreciate what you're saying, that you might not want to spend a lot of money on term sheets. At least I definitely think you should read the free ones before you go to a lawyer, because lawyers are not your friends when it comes to fundraising, because you know, that's where they make money, right? By taking their cut. So you should go prepared before you go to a lawyer. And I think what you're mentioning is great. You should share the link maybe after the session on whether go prepared to a lawyer. And I think if you go prepared to a lawyer, you go prepared to the investor. Yeah, maybe that.
No, we talked about the different forms, convertible share investments. So back to the audience if there are any questions.
So just when investors actually put in money into a business, what factor actually plays a major role on the ground? And are they more interested in a business which is more revenue making or more profit making, if it's already making some profits?
Okay, so how much to invest and
So
probably also linking to
an organization is making $100, it's making some 30% margin, 30 bucks. It's compared to an organization which is making $1,000 with a 2% margin of $20. So as regard of startup environment, need more revenue and more money from investors, what exactly helps you know making that money?
Let me add to that. So how much also valuation, right? It's a topic we've not touched on. How is that the valuation pre and post money? So before the investment come in and afterwards. I think this is linked also to the amount of what you're raising.
I like what William said about there's many different types of investors. Right? So, in theory, if the ones that are just doing it for the thrill or something, they actually shouldn't be called investors, because an investor is actually looking for a return on top of their investment, right? So if on one side you have the serial entrepreneur that is out of the comfort zone, that's building a business to increase his personal wealth, and that has data backing it, those are the kind of entrepreneurs that create the highest growth companies, most amount of jobs, and consequently the biggest impact, then you should have that same kind of thinking of investor-wise. So this guy, together with an investor that is also looking for huge returns, huge returns, that would be the best fit between an entrepreneur and an investor. So more importantly than actually the amount of revenue you have in the beginning, I think it's more of a personality trait type fit between the entrepreneur. I would look at that first, but valuation is important.
So you asked what's better, high revenues or high margin. I think that when we look at companies, we actually look at how big the company can get. And I think if you're a rational investor, and some people think this is like evil or not good, but in the end of the day, right, the business is only worth the sum of its future cash flows. And the money which is in the bank, and the only money is loan you take, right? That's actually the rational way to look at it. So you actually want to kind of estimate the future cash flow of the business. That's the only good answer to it. If the business has interesting future cash flows, and you think that you are will be able to raise the amount of capital needed to reach those cash flows, you would prefer the business with the highest cash flow. Of course, weighted down, right? So it can happen in 100 years, that's happening, right? Within a decent amount of time.
I actually agree, because the worst thing you want is a business that's not making enough cash flows and revenues and profits, that it keeps having to raise money, and you keep getting diluted and diluted and diluted, and that is a big issue for an investor.
Let me do a little bit of a contrarian comment on that. So we need to remember that the greatest event for an entrepreneur, when all that time and money and suffering and being out of the comfort zone, when all that pays off, is when there is some kind of an exit. Either because he was acquired by a bigger company, or much more difficult to happen when he went public, or he handed off the business in some other way, right? So if that is I call that a strategic exit is the greatest value creator for entrepreneurs and many more that are with him. his immediate team, his early employees that have stock options, the investors. So yes, there are the financial aspect of the future cash flow is very reassuring to investors, because that can help you know that you have a business that is self-sustainable rather than everybody getting diluted, like you mentioned. But there are a few strategic exits out there that are companies that actually don't even have revenue. I don't know if you guys remember Mailbox. I think it was Mailbox.com. They had, I think, like 800,000 pre-signups for some iOS mailbox thing they were doing, and Dropbox bought that company for $100 million. And well, WhatsApp, right? Very little revenue and $19 billion. So the playing field is diverse. There are many different games going on in entrepreneurship, different kinds of businesses. You as an entrepreneur need to be honest with yourself as why you are into entrepreneurship in the first place. Make a decision what kind of game you want to play, and surround yourself with advisors that have won that game and can help you what I advocate for, reach an exit. So it's kind of a different perspective that I wanted to share.
I totally abide by what you said, Rodrigo. I think in its entirety. All I'll do is I'll put the Asian perspective on it. I mean, if you're here, your business is here, you're looking for investors here, you don't really have a network in Europe or wherever, California, etc. You've got to think about what people are looking to invest in. Are they after self-sustaining businesses, or are they after WhatsApp-like businesses which just show remarkable traction or revenue? What is it? And I think, and I might be wrong, you guys know the investor landscape better than me, but I feel people here are still very much looking for the numbers. They want to see numbers, not just in terms of customers, but they want to see revenue, they want to see cash flow, they want that with self-sustaining characteristics. I think it goes back to what you said, Pooja, right? And most of the money is coming from tycoons or families who've invested in things like real estate where they've seen yield, right? It's a very yield-hungry market here, so they want to see those sort of numbers. Having said that, it's changing rapidly. I mean, just look at what's happened in China in the last 18 months. I mean, those guys have, I think, superseded even like the Californian appetite for just growth without numbers. I mean, the type of raisings that are happening in China are ludicrous. Maybe it's a mini bubble there or whatever it is, but I guess then it goes back to networking to see what's happening in the market, because that's the practical thing, right?
Okay, investor profile, but I can discuss on guidance.
I just want to add. Sorry. I just want to add to my answer, because my answer sounds like some kind of textbook, right? But in a way, it's still true, right? It's true without the bubble, with the bubble. What happens in the bubble, and what also happens in the internet economy that people in the traditional, financial world don't appreciate is that, for example, in a lot of online businesses, value is actually created by growing number of users, because you know that in the future you might be able to actually charge those users, and they might pay you money, and then they will create the free cash flows, and then everything is correct again, right? But it's just that when you do online businesses, the way to actually show and prepare for a later value and later cash flows is to grow users and not necessarily revenue in the first 2, 3, 4, 5 years of the business. And that is something, and forget the bubble right now, that is something that traditional investors, especially in Singapore, and I've been investing here since 2004, very few investors actually realize that. So in many cases, while a Silicon Valley investor might say, just go out and get new users and make this a dominant platform in the world, a typical family office perhaps, or a typical Asian investor would say, please at least get some revenues in, because otherwise we won't support it anymore. And therefore, you don't see any Facebook coming out of Singapore so far. But that's really starting to change right now. Now you're starting to see a lot of investors in this region being, as savvy as Silicon Valley.
A lot of them are important.
Right. Then, yeah. And then you have the bubble effect again, right? And the bubble effect is like basically saying, I don't really care about the cash flows or whatever. I care about who I can sell this company for at a fantastic valuation within 18 months, right? Which is the investment model of some investors right now, especially because it is a bubble. So that's more to Rodrigo's point as well, right? I mean, you can actually invest based on, not based on cash flows, but based on if you can sell this company for $100 million to someone later. So if you invest in a mailbox, perhaps that was the idea, that they actually understood Dropbox actually is a very sensible buyer, and then, you know, there's a totally different game here. So just one.
I think William used a very good word, goodwill. And a lot of the deals out there happening are, most of the actual valuation is all based on future goodwill. So I think part of every entrepreneur's job is to be a very good and persuasive seller of goodwill in the future, right? And again, goodwill is, obviously this is more biased to online B2C type tech startups. Boils down to the number of users you have, right? So the deals are always related to multiples. Some kind of, my first company that was purchased basically on revenue, solely on revenue. So I was paid 1.8 times my annualized revenue because the company that bought me, they were being traded in NASDAQ. PSInet was a global ISP. They were being traded. The analysts were saying, PSInet is a global ISP, therefore it is worth 6 times its annualized revenue. Just to make the numbers very easy, let's say it had $1 billion of annualized revenue. It was being traded at $6 billion of market cap in NASDAQ. So what was PSInet's growth strategy? And I wish I had learned this before I sold the company, but I learned this after I sold the company. Otherwise I could have gotten a better deal. But basically they said, why don't we go out all across the world and buy revenue? Of course, we're an ISP, we can't go and buy an F&B business because it's going to look weird to the analysts, right? Let's go out there and buy other ISPs, but do you think they're going to go out there and buy us for 6 times revenue? No, they don't have any upside. So I learned afterwards, because I joined their M&A team for the next deals, that they were willing to pay up to 3 times annualized revenue, but the M&A execs from the acquirer, they were told, look, try to pay the least you can because your year-end bonus is going to be bigger the less you pay your acquisition targets. It's true, that's just the way it is. So basically, when I sold my first company, I was like, wow, the CEO of PSInet came and saw what I did, and we're going to be buddies, and he loved my vision and what I've done, and etc., Brazil, etc., etc. But at the end of the day, all he cared about was my revenue, and that he was buying it for 1.8, putting it into his books for the NASDAQ, the US GAAP, whatever that's called. I'm not very financially savvy, by the way. And when he puts it in, he gets an automatic upside. So at the end of the day, you need to identify what is the value driver from your acquirer's perspective. It could be revenue, and then obviously you have these multiples, discounted cash flow. It could be just pure eyeballs, right? It could be pure eyeballs, it could be future goodwill, it could be many things. So basically, you need a strategy to help you identify those value drivers and maximize the return for yourself.
Well, thanks for sharing that. That's very helpful because, I mean, fundraising, building, exit ultimately, unless you want to build a lifestyle business for you, which is profitable, I mean, that's the other option you always have. I have one more question to you. There are a bunch of advisors out there who try to help you raise money, and they take money for that, be it percentage of what you raise, be it a retainer, be it equity, a combination of all 3 of them. What do you think about that?
I should have done that. I've helped, but I've never taken anything for it.
That's very generous. Yeah. William, have you had cases where companies were raising money from you and they had a financial advisor or a fundraising advisor?
Yeah, I use financial advisors. Yeah, I think it's really hard to find a good advisor that actually raises money for you. I think that's the first thing. I never had a good experience using a fundraiser for portfolio company. But I haven't had that many bad experiences either. I think it's okay to actually get paid for it. It's a lot of work. You know, you can see people taking 1, 2, 3, 4, 5%, depends. I think it's a fair business as any other business. It is difficult to get in front of the right investors in a limited amount of time. It's just really hard to find the right one. Yeah.
I think there's a difference between supporting and being committed to, right? So I'm always happy to support entrepreneurs as I go in any way I can, right? But there's a difference between supporting, helping, doing an introduction, and actually being committed to someone's success in whatever way, either because you're helping them to fundraise, and when you're committed, I'm guessing the person has to put in man hours or his hours into the business. So I don't see an issue with the person getting a fair reward for his commitment, but just for doing like an intro or support, I don't know, then maybe it's more like what you're doing.
Basically, if I feel I find a match, I make an intro, but I don't go further. So I mean, I've actually never taken any equity or anything for doing that. But yeah, I mean, if someone's committed and they do all the work for you, it makes sense.
I have in the fund we're trying to build right now, if you're an advisor to our fund, you actually get 1% of the profits we will eventually make, if we make it, for making an introduction. So that's the deal we give to our mentors, basically introducing good companies. And also for supporting the company through fundraising and further work, we actually give even more of a profit share. So, one important thing when you work with fundraisers is that some of them actually require a kind of payment per month or per time unit, and that is kind of tricky. So at least if you work with a fundraiser, make sure it's a no cure, no pay deal. Don't get dragged into a situation where he actually makes more money the longer his kind of engagement lasts.
So I have one very last question for Raghav. Actually, you just raised money. After the raising is before the raising, actually. That's what many per se in fundraising. So meaning, once you've closed the round, actually you have to think already of the next one. If you build a growth business, are you thinking of the next fundraising round?
Yeah, definitely. I mean, I'm always thinking about the next thing. Whether it's fundraising or the next sale or the next tech feature or, same. I don't think of it any differently. The way I think about my business is I think about all the risks that my business is exposed to, and I think about what are the various different ways of de-risking my business against each of those risks. It's a very strange way of looking at it, but it goes back to my background in whatever, my education and so on. So I think about risk. And I feel that as I take more and more and more risks out of a business, it's adding value, right? So I think capital risk is something I always think about. How many, what is how long will my capital last in the most adverse of circumstances? So, I mean, actually tying back to the question these guys were answering, right? Using advisors. That's what banks do, right? Like that's what investment banks do. They take a fee and help you raise money, right? For bigger companies, obviously, right? And banks have existed and they trade on multiples and whatever. So it's not new business, it exists. But for me, if I'm a very young company, the first thing I'd ask an advisor is, are you happy taking equity instead of your cash? Because you're helping me raise cash. I need cash. If you then take cash out of the cash you raise, then you're not helping me as much. Take equity, right? And so that would be a little bit of a litmus test. I might still want to just get the cash because equity might be precious to me, but at least you know where this guy's coming from. Does he really believe in your business? Because if he doesn't, you've just reduced your valuation. Because he's going to go and talk to 100 different people and say stuff that doesn't really bode well for your business. Either he doesn't understand your business. Basically, you just picked a bad representative. That's my little test for a very early stage business. And yeah, I mean, always think about capital just like you think about anything else. That any other need of the next hire, the next feature, the next.
Don't forget the cash flow, actually. Not the cash flow, no next fundraising, right? So, thanks for the great answers. I hope you could get to know the panelists through that a bit better. I mentioned before the legal documents. Actually, there's a website called cofounders.sg, cf.sg. There you find all the templates I was mentioning under the legal section. And I guess TIE has also a number of resources probably available for you to look at. So thanks a lot to our 4 panelists, thanks a lot to TIE to organize this here. And I guess we're still sticking around a little while if you have more questions now to ask more individually rather than to keep you going here in the big round. So thanks everybody, big applause for our 4 panelists.
Thank you very much. Thanks, everybody. I'd encourage actually for you to stay back. We've got some snacks, some drinks around. Please network. There are some of our Thai members around here. Please feel free to actually talk to them. I see Roshni in the